Question 1. The interest income from a general obligation bond issued by a municipality within an investor's state of residence is typically A. Subject to federal income tax only. B. Exempt from federal income tax but subject to state and local taxes. C. Subject to federal, state, and local income taxes. D. Exempt from federal, state, and local income taxes. Answer: D. Exempt from federal, state, and local income taxes. Interest income from municipal bonds is generally exempt from federal income tax. For bonds issued by a municipality within an investor's state of residence, the interest is typically also exempt from state and local income taxes, granting them triple tax exempt status. This significant tax advantage makes municipal bonds particularly attractive to high net worth individuals seeking to reduce their overall tax burden. Remember that while interest is often tax exempt, any capital gains from selling the bond for a profit are always taxable. Question 2. Which of the following is responsible for appointing the MSRB, Municipal Securities Rulemaking Board, members? A. The Secretary of the Treasury. B. The Securities and Exchange Commission, SEC. C. The Financial Industry Regulatory Authority, FINRA. D. The Government Accountability Office, GAO. Answer: B. The Securities and Exchange Commission, SEC. The Municipal Securities Rulemaking Board, MSRB, is a self-regulatory organization, SRO, that creates rules for municipal securities firms and professionals. While the MSRB establishes these rules, it does not enforce them. Enforcement falls primarily to FINRA and the SEC. The Securities and Exchange Commission, SEC, is responsible for appointing the MSRB members, overseeing its operations, and approving its rules, highlighting the SEC's ultimate authority over the municipal securities market. It's important to remember that the MSRB's primary function is rulemaking, not enforcement. Question 3. An investor in a high tax bracket is considering purchasing a municipal bond or a corporate bond with a 6% coupon. If the municipal bond offers a 4.5% tax-free yield, what is the taxable equivalent yield for the municipal bond if the investor is in a 25% federal tax bracket? A. 4.5%. B. 5.625%. C. 6%. D. 7.25%. Answer: C. 6%. To calculate the taxable equivalent yield, you divide the municipal bond's tax-free yield by 100% minus the investor's tax bracket. In this case, the formula is 4.5%/100% to 25%, which is 4.5%/0.75. This calculation results in a taxable equivalent yield of 6%, meaning a taxable bond would need to yield 6% to provide the same after-tax return as the 4.5% tax-free municipal bond. Understanding this calculation helps investors compare municipal bonds to taxable investments on an apples-to-apples basis. Question 4. A bond counsel's opinion for a new municipal bond issue typically addresses which of the following? A. The marketability and liquidity of the bond. B. The creditworthiness and financial health of the issuer. C. The legality of the issue and its tax-exempt status. D. The projected future interest rates and their impact on bond prices. Answer: C. The legality of the issue and its tax-exempt status. The Bond Counsel is a law firm specializing in municipal bond law, and their opinion is a critical document for new municipal bond issues. This opinion attests to the legality of the bond issue, confirming that the issuer has the authority to issue the bonds and that the interest income is exempt from federal taxation. Investors rely on this legal opinion to confirm the fundamental legal standing and tax characteristics of the bond. Always look for the Bond Counsel's opinion when evaluating new municipal bond offerings. Question 5. Which of the following municipal bonds is typically repaid from the revenues generated by a specific project or facility, such as a toll bridge or airport? A. general obligation, GO, bond. B. Moral obligation bond. C. Revenue bond. D. Special assessment bond. Answer: C. Revenue bond. Revenue bonds are distinct from general obligation bonds because their debt service payments, including interest and principal, are funded solely from the revenues generated by the specific project or facility built with the bond proceeds. Examples include toll roads, airports, hospitals, and water or sewer systems, where user fees or charges directly support the bond. This means the bond's repayment is tied to the success and profitability of that particular enterprise, rather than the general taxing power of the municipality. Question 6. An official statement, OS, for a new municipal bond issue would typically include which of the following information? A. Real-time trading prices and current yields of the bonds. B. A prospectus detailing the managing underwriter's compensation. C. Detailed financial information about the issuer and the project, and the legal opinion. D. Predictions about future economic conditions and interest rate trends. Answer: C. Detailed financial information about the issuer and the project, and the legal opinion. The official statement, OS, is the primary disclosure document for a new municipal bond issue, analogous to a prospectus for corporate securities. It provides comprehensive financial information about the issuer, details about the specific project being financed, and important legal considerations, including the bond counsel's opinion. The OS is essential for potential investors to conduct their due diligence and make informed investment decisions regarding the credit quality and risks of the municipal bond. Question 7. All of the following are types of debt instruments that might be issued by a municipality except: A. General obligation bonds. B. Revenue bonds. C. Certificates of deposit, CDs. D. Tax anticipation notes, TANs. Answer: C. Certificates of deposit, CDs. Certificates of deposit, CDs, are savings certificates issued by banks, credit unions, and other financial institutions, not by municipalities. Municipalities issue various types of debt instruments to finance public projects and operations. General obligation bonds and revenue bonds are long-term municipal debt, while tax anticipation notes, TANs, are short-term municipal notes used to manage cash flow in anticipation of future tax receipts. Remember that CDs are bank products, distinct from municipal securities. Question 8. The full faith and credit pledge backing a municipal bond refers to the issuer's commitment to repay from: A. Specific project revenues only. B. Ad valorem taxes and other general revenues. C. Earnings from private corporations. D. Federal government subsidies. Answer: B. Ad valorem taxes and other general revenues. When a municipal bond is backed by the full faith and credit of the issuer, it signifies that the bond is a general obligation, GO, bond. This pledge means the issuer promises to repay the debt using its general taxing power, which includes property taxes, ad valorem taxes, sales taxes, income taxes, and other general revenues collected by the state or local government. This broad backing makes GO bonds generally considered less risky than revenue bonds because repayment is not dependent on a specific project's success. Question 9. Which of the following is typically a short-term municipal security issued in anticipation of receiving future federal or state payments? A. General obligation bond, GO. B. Public Housing Authority bond, PHA. C. Grant anticipation note, GN. D. Industrial Development Revenue Bond, IDR. Answer: C. Grant Anticipation Note, GAN. Grant Anticipation Notes, GANs, are short-term municipal notes issued in anticipation of receiving funds from future federal or state grants. Municipalities use GANs to manage immediate cash flow needs while awaiting the actual receipt of grant money for specific projects or programs. Other short-term municipal notes include TANs, tax anticipation notes, and RANs, revenue anticipation notes, all designed to bridge funding gaps. Question 10. A municipal bond with a par value of $5,000 is quoted as 102 1/4. What is the dollar price of this bond? A. $1,022.50. B. $5,012.50. C. $5,112.50. D. $5,250. Answer: C. $5,112.50. Municipal bonds are typically quoted as a percentage of their par value, with each point representing $10. A quote of 102 1/4 means 102.25% of par. Since municipal bonds commonly have a par value of $5,000, you calculate the dollar price by multiplying the par value by the quoted percentage. $5,000 * 1.0225 equals $5,112.50. Understanding municipal bond quotes is crucial for accurately determining the cost of a bond. Question 11. Which of the following statements about municipal bond interest payments is true? A. They are always taxable at the federal, state, and local levels. B. They are subject to the alternative minimum tax, AMT, for all investors. C. They are generally exempt from federal income tax. D. They are always taxable at the state and local levels, regardless of where the investor resides. Answer: C. They are generally exempt from federal income tax. A primary attraction of municipal bonds for investors is that the interest income they generate is generally exempt from federal income tax. This tax-exempt status can provide a significant advantage, especially for investors in higher tax brackets. While some municipal bond interest may be subject to the alternative minimum tax, AMT, for certain investors, and state and local taxes may apply depending on the issuer and investor's residence, the federal tax exemption is a fundamental characteristic. Question 12. A municipal bond's offering price is generally determined by A. Its initial coupon rate. B. The issuer's credit rating at the time of issuance. C. Supply and demand in the market, along with prevailing interest rates and the bond's credit quality. D. The bond's par value, which is fixed at $1,000. Answer: C. Supply and demand in the market, along with prevailing interest rates and the bond's credit quality. Like most securities, the offering price of a municipal bond in the secondary market is primarily influenced by the interplay of supply and demand. Factors such as current market interest rates, the bond's credit quality, its rating, its maturity, and any call features significantly impact its price. A bond's initial coupon rate and par value are set at issuance but do not solely determine its price in the secondary market, which fluctuates based on these dynamic market forces. Question 13. Which of the following is most likely to be a source of repayment for a municipal revenue bond? A. Property taxes collected by the city. B. Tolls from a turnpike. C. Sales taxes collected by the state. D. Income taxes collected by the municipality. Answer: B. Tolls from a turnpike. Revenue bonds are paid back from the revenues generated by the specific project they finance. A turnpike is a classic example of a project that generates its own revenue through tolls charged to users, which then service the debt on the bonds issued to build or maintain it. Property taxes, sales taxes, and income taxes, on the other hand, are sources of general revenue that typically back general obligation bonds. Question 14. What is the main role of the MSRB, Municipal Securities Rulemaking Board? A. To enforce municipal securities laws and regulations. B. To act as a municipal bond rating agency. C. To create and enforce rules for municipal securities firms and professionals. D. To underwrite and distribute new municipal bond issues. Answer: C. To create and enforce rules for municipal securities firms and professionals. The MSRB's primary function is to create rules for municipal securities brokers, dealers, and municipal advisors to ensure a fair and efficient municipal market. While the MSRB sets these rules, it does not directly enforce them. Enforcement responsibilities are carried out by regulators like FINRA and the SEC. This separation of rulemaking and enforcement is a key characteristic of the MSRB's structure. Question 15. An investor who lives in New York City buys a municipal bond issued by the City of New York. The interest received from this bond would likely be: A. Subject to federal income tax only. B. Subject to state and local income taxes only. C. Exempt from federal, New York State, and New York City income taxes. D. Fully taxable at all levels due to double taxation. Answer: C. Exempt from federal, New York State, and New York City income taxes. When an investor purchases a municipal bond issued by a municipality within their own state and city of residence, the interest income typically qualifies for triple tax exempt status. This means the interest is exempt from federal income tax, state income tax, and any applicable local income tax. This specific tax advantage is a significant reason why investors choose to buy municipal bonds from their local jurisdictions. Question 16. Which of the following statements about general obligation, GO, bonds is true? A. They are considered riskier than revenue bonds due to reliance on specific project revenues. B. They are backed by the full faith and credit and taxing power of the issuing municipality. C. They are typically issued for specific projects like airports or toll roads. D. They are exempt from federal taxation but subject to state income tax in all cases. Answer: B. They are backed by the full faith and credit and taxing power of the issuing municipality. General obligation, GO, bonds are debt instruments issued by states, counties, or cities that are backed by the issuer's general taxing power and overall financial strength, often referred to as their full faith and credit. Unlike revenue bonds, their repayment is not dependent on the success of a specific project, making them generally considered less risky. This broader backing makes them a staple in many municipal bond portfolios. Question 17. The term net direct debt is most relevant when analyzing the creditworthiness of which type of municipal bond? A. Revenue bonds. B. General obligation, GO, bonds. C. Industrial development revenue bonds. D. Moral obligation bonds. Answer: B. General obligation, GO, bonds. Net direct debt is a key metric used in evaluating the creditworthiness of general obligation, GO, bonds. It represents the total debt of the municipality, excluding self-supporting debt, like revenue bonds, and overlapping debt, giving a clearer picture of the direct debt burden backed by the issuer's general taxing power. This ratio helps analysts assess the issuer's ability to repay its GO debt from its general revenues. Question 18. What is the purpose of an official statement, OS, in a municipal bond offering? A. To guarantee the bond's performance and market price. B. To provide material information about the bond and the issuer to potential investors. C. To advertise the bond offering to the general public. D. To serve as the legal contract between the issuer and the bondholders. Answer: B. To provide material information about the bond and the issuer to potential investors. The official statement, OS, is the primary disclosure document prepared by the issuer for a municipal bond offering, providing comprehensive information necessary for investors to make informed decisions. It includes details about the issuer's financial condition, the bond's terms, sources of repayment, and any significant risks. This document is crucial for due diligence and ensuring transparency in the municipal securities market. Question 19. A municipal bond with a callable feature allows the issuer to: A. Increase the interest rate if market rates rise. B. Extend the bond's maturity date. C. Redeem the bond prior to its stated maturity date, typically at a specified call price. D. Convert the bond into equity shares of the municipality. Answer: C. Redeem the bond prior to its stated maturity date, typically at a specified call price. A callable feature on a municipal bond grants the issuer the option to buy back or call the bonds before their scheduled maturity date. Issuers typically exercise this option when interest rates have fallen significantly, allowing them to refinance the debt at a lower cost. For investors, callable bonds carry reinvestment risk, as their bonds may be called when interest rates are low, forcing them to reinvest at less favorable yields. Question 20. Which of the following entities is responsible for enforcing MSRB rules for broker-dealers that are FINRA members? A. The Municipal Securities Rulemaking Board, MSRB, directly. B. The Securities and Exchange Commission, SEC, only. C. The Financial Industry Regulatory Authority, FINRA. D. The Department of the Treasury. Answer: C. The Financial Industry Regulatory Authority, FINRA. While the MSRB writes the rules for municipal securities firms and professionals, it does not enforce them itself. Enforcement of MSRB rules for broker-dealers that are also FINRA members falls to FINRA. The SEC also has enforcement authority over all participants in the municipal securities market. Understanding this distinction between rulemaking and enforcement is vital for navigating the regulatory landscape. Question 21. What is the primary risk associated with a municipal revenue bond, distinct from a general obligation bond? A. The risk that federal tax exemption may be revoked. B. The risk that the specific project generating the revenue may not be successful or generate sufficient income. C. The risk that the issuer's overall taxing authority will diminish. D. The risk of inflation eroding the purchasing power of interest payments. Answer: B. The risk that the specific project generating the revenue may not be successful or generate sufficient income. The primary risk for a municipal revenue bond is that the specific project or facility it finances, example a toll road, airport, or hospital, might not generate enough revenue to cover the debt service payments. Unlike GO bonds, which are backed by the issuer's broad taxing power, revenue bonds rely solely on the cash flow from their designated revenue source. Investors in revenue bonds must therefore carefully assess the viability and financial projections of the underlying project. Question 22. A certificate of participation, COP, is a type of municipal security where A. Investors directly own a share of the financed project. B. Investors purchase a share of lease payments from a municipality. C. The bond is backed by the full faith and credit of the federal government. D. The interest is always subject to the alternative minimum tax, AMT. Answer: B. Investors purchase a share of lease payments from a municipality. A certificate of participation, COP, is a type of municipal security that allows investors to participate in a stream of lease or installment payments made by a municipality. These payments typically relate to a specific project, such as a building or equipment, that the municipality leases from a separate entity created to issue the COP. Unlike traditional bonds, COPs do not usually represent a general obligation of the issuer backed by its taxing power, but rather a proportional interest in specified revenue streams. Question 23. What is the purpose of a feasibility study when issuing municipal revenue bonds? A. To determine the bond's credit rating. B. To assess the likelihood that the project revenues will be sufficient to cover debt service. C. To obtain legal validation for the bond issue. D. To secure federal backing for the project. Answer: B. To assess the likelihood that the project revenues will be sufficient to cover debt service. A feasibility study is a crucial step in the issuance of municipal revenue bonds, designed to evaluate the economic and technical viability of the project being financed. This study assesses whether the projected revenues from the project, example tolls, user fees, will be sufficient to cover the bond's debt service payments, including principal and interest. It provides an independent analysis for potential investors and helps determine the overall risk of the revenue bond. Question 24. All of the following are typically considered when analyzing the creditworthiness of a general obligation, bond except A. The community's overall economic health and population trends. B. The municipality's debt burden and tax collection record. C. The specific revenues generated by a particular enterprise project. D. Overlapping debt and unfunded pension liabilities. Answer: C. The specific revenues generated by a particular enterprise project. When evaluating a general obligation, bond, analysts focus on the municipality's overall financial strength and its ability to raise revenue through taxation. Therefore, factors like the community's economic health, population trends, existing debt burden, tax collection efficiency, and unfunded liabilities are all highly relevant. However, the specific revenues generated by a particular enterprise project are relevant only for revenue bonds, not bonds, as bonds are backed by the general taxing power of the issuer. Question 25. Which of the following is an example of a flow of funds provision found in a municipal revenue bonds bond resolution? A. A pledge that the issuer will repay the bond from its general tax revenues. B. A covenant that dictates the order in which revenues from the project will be applied to expenses and debt service. C. A statement granting the bond an insured status by a third party. D. A provision allowing bondholders to convert their bonds into common stock. Answer: B. A covenant that dictates the order in which revenues from the project will be applied to expenses and debt service. The flow of funds provision, typically found in the bond resolution or trust indenture for revenue bonds, establishes the priority in which collected revenues from the financed project will be used. This covenant specifies the order of payments, for instance, first for operations and maintenance, then debt service, then reserve funds, and so on. Understanding the flow of funds is critical for assessing the security and risk of a revenue bond, as it defines how bondholders are paid from the project's income.